A massive backlog of late-stage tech giants is currently under heavy pressure to seek public liquidity. After a multi-year drought in the IPO space, these massive centicorns are finally preparing to flood the public markets. This pipeline is dominated by three specific targets: OpenAI, Anthropic, and SpaceX. If all three list in the same year, they could collectively raise over $100 billion. This chart compares SpaceX's estimated $1.75 trillion valuation against today's tech giants. At this scale, it trails only Apple and NVIDIA. The exchange securing this listing captures huge annual fees and ensures massive capital flows from passive ETFs are directed onto their platform. Securing these three listings moves the needle far beyond simple quarterly earnings. It is an existential race to become the definitive venue for the AI and aerospace sectors. But the New York Stock Exchange is facing a severe threat. NASDAQ has aggressively used its technology branding to dominate high-profile tech listings for years. NASDAQ is also using massive incentive packages to win business, recently poaching chip designer ARM with a deal reportedly worth $50 million. The NYSE suffered another setback when Walmart, the world's largest retailer, defected to NASDAQ to align its stock with tech-focused index funds. Simultaneously, the new Texas Stock Exchange is emerging as a regional rival. Backed by Wall Street heavyweights like Goldman Sachs and JP Morgan, it is positioning itself as a business-friendly alternative for firms looking to leave New York entirely. The New York Stock Exchange simply cannot win this battle by offering faster computer servers or marginally lower listing fees. To survive, they have to pivot the competition to a different kind of battlefield, but their advantage lies in their physical space. Unlike NASDAQ, which operates entirely electronically, the NYSE possesses a 200-year-old heritage and an iconic architectural presence in Lower Manhattan. Their strategy is to weaponize that history. They are currently renovating a subterranean underground vault into an invite-only private members club. For most of the 20th century, this vault was used to physically lock away paper stock certificates and tangible wealth. Today, the space serves a different purpose. The club is not designed to turn a profit on food and beverage. It operates as a strategic loss leader to secure high-value listing fees. The NYSE is intentionally building a social perimeter. They are offering tech founders a physical sanctuary and a sense of prestige that purely electronic exchanges cannot replicate. The architect of this physical strategy is NYSE Group President Lynn Martin. Martin began her career as a computer programmer for IBM and now oversees a system processing 500 billion electronic messages every single day. Yet she is the one championing this return to relationship-driven, physical commerce. Martin holds final authority over the invitation criteria for the new club, personally deciding which financial luminaries and executives are granted entry into the vault. The value proposition for a tech founder is direct access. Instead of sitting through administrative pitch meetings, they are granted total privacy with sovereign wealth managers and institutional allocators behind closed doors. The strategy implies that while executing a trade requires cutting-edge algorithms, winning a trillion-dollar listing still requires a seat in the same room. This high-touch social strategy is necessitated by a major shift in the market. Successful companies are now choosing to stay private for much longer than they did in previous decades. This chart tracks the rising average age of companies at their IPO, plotted against the growth of private capital pools. With roughly $16 trillion in global private capital now available, hyper-jumbo centicorns can mature and scale without ever needing to tap the public markets for funding. This creates a structural problem for exchanges. By the time these giants finally seek an IPO, they are already established global ecosystems. They have effectively outgrown standard marketing pitches. Exchanges can no longer wait for a company to arrive at their door to ring the opening bell. They have to insert themselves into a company's life cycle while it is still private. This is the logic behind the NYSE's digital expansion. Their parent company, Intercontinental Exchange, recently launched ICE Private Credit Intelligence, a platform designed to track and index institutional debt within the private markets. The data platform and the physical social club work in tandem. They bind these super unicorns to the NYSE ecosystem years before the companies ever require a ticker symbol. The coming battle for SpaceX, OpenAI, and Anthropic will determine if this hybrid of digital data and physical social capital actually works. Trillions of dollars now move through global markets via nanosecond code. Yet the future of Wall Street is currently being negotiated in a basement vault over a handshake. 免责声明，本视频内容仅用于信息分享和学术探讨，不构成任何投资建议或决策依据。听众在进行投资或职业选择时，应充分考虑自身情况与专业意见。你认为 SpaceX 最终会选择底蕴深厚的纽交所，还是科技标签鲜明的纳斯达克？欢迎在评论区留下你的看法。如果你觉得本期内容对你有启发，欢迎关注视频号华尔街透视，并请您点赞、转发，让更多朋友一起加入讨论。我们下期再见。